The Asian guy is back, new channel, new energy, same mission. They thought deleting a channel would silence the message. They were wrong. Truth doesn't disappear because a platform hits a button. It just finds a new audience. We rebuild. We come back louder, smarter, stronger. If you're here, you're early. Today is Wednesday, the 13th of May, 2026. Silver is trading at $87.13 per ounce. Gold sits at $4,688.30, and those numbers on the screen are almost beside the point. Because the real story is not in the price. The real story is inside the vaults, and right now the vaults are getting empty. Here is what is happening. China, the world's largest industrial consumer of silver, has stopped exporting the metal, not slowed down, stopped, and it has not just stopped exporting, it has flipped entirely. In March of this year, China imported 520 tons of silver, 520 tons in one single month. That is the largest monthly silver inflow recorded in over 20 years. And that number is still climbing. At the same time, on the other side of the Pacific, the COMEX in New York, the exchange where silver futures are physically settled, has been watching its registered inventory fall, less coming in, more going out, and here is the detail buried inside a UBS report that almost nobody in the retail world has absorbed yet. A significant portion of the silver remaining in those New York vaults may be Chinese origin metal. And if the trade war between the United States and China escalates to a specific legal threshold, a mechanism called Section 301, that silver becomes untouchable, not stolen, not confiscated, just legally stranded, inaccessible for the contracts and deliveries that the market depends on. This is not a Reddit theory. This is not a YouTube rumor. UBS published it. Vince Lanciani, adjunct professor of corporate finance at the University of Connecticut, publisher of the VBL Gold Fix on Substack, and one of the sharper minds tracking the metals market, confirmed it in detail on record. And the chart on every single time frame you can look at, daily, weekly, monthly, is pointing at the same number. $95 per ounce, that is the resistance, that is the ceiling. And what happens at 95 will define the next major chapter for silver. Stay with me, because by the end of this video you are going to understand exactly what is being built, what is at stake, and what the market is telling you to do about it. To understand why the China flip matters so profoundly, you need to understand what China's role in the global silver market has historically been. For years, not months, years, China operated as a net exporter of silver. It produced the metal domestically, consumed what its own industrial base required, and released the surplus into global supply chains. The global silver market treated Chinese exports as a reliable release valve when supply got tight anywhere in the world. Chinese metal was part of the solution. That assumption is now structurally broken. China imported 520 tons in March alone. The word that Lanciani used to characterize this transformation was voracious. Not active, not elevated. Voracious, and the reasons are not mysterious. China's domestic demand for silver is accelerating. Solar panels require silver. Electric vehicles require silver. The advanced electronics and battery technology that China has made a national industrial priority require silver at a scale that the global market has not yet fully internalized. On top of that, with an active trade confrontation with the United States, China has a strategic incentive to accumulate physical metal rather than leave it exposed to supply chain disruption. What this creates for the rest of the world is a one-way drain. The release valve has not just been closed, it has been turned into an intake valve. The flow has reversed direction entirely. And when the world's largest industrial consumer of a metal goes from net supplier to voracious importer, the pressure does not build gradually. It builds the way water pressure builds behind a closing gate, slowly at first, then all at once. Right now, that pressure is pointed at New York. The phrase Lanciani used to describe the current situation carries more weight than it might initially seem. He called it a venue squeeze, not a short squeeze. A venue squeeze. The distinction is critical, and most people are missing it. In a short squeeze, price is the problem. Short sellers are forced to cover, and the covering drives the price up. That is a leverage story. That is a positioning story. In a venue squeeze, price is the symptom. The actual problem is geography, location. There is silver in China. China is not sending it back. There is silver in New York. But it is declining, and a meaningful portion of what remains in those New York vaults may be Chinese origin metal that under escalating trade restrictions cannot legally be moved into the deliveries and settlements that the market needs. What this creates is a situation where the global silver supply in aggregate may be adequate, but adequate at the wrong location, inaccessible under the wrong legal framework, or simply unavailable to the entities that need it most. And when you overlay settlement deadlines and delivery obligations onto that kind of structural mismatch, the pressure does not stay conceptual. It moves into the price. UBS, in its report, described the situation in measured institutional language. The bank said recent strength and volatility in silver is being driven by tightening delivery conditions, shifting metal flows, and confusion surrounding United States trade policy. That is a major bank, informal language, saying the plumbing is getting blocked. And when the plumbing in a physical commodity market gets blocked, prices do not wait for a committee report, they adjust. Now, UBS characterized this as likely temporary rather than structural. Lanciani challenged that framing directly. He pointed to a pattern that repeats every time a metal's dislocation gets labeled transitory by Mainstream institutions. The example he cited was the London market, the LBMA, where the argument was always, there is plenty of metal, it just needs to get from point A to point B, and then repeatedly it never quite got there as smoothly as promised. The metal existed, the logistics did not cooperate, the legal frameworks complicated things, and prices moved upward to compensate for what was described, right up until it wasn't, as a temporary problem. Lanciani's position is that we are watching that pattern replay right now in silver, and that the institutional language around transitory and short-term is less an accurate description and more a professional obligation to not sound alarmist. What matters is not what the report says. What matters is what the vaults say, and the vaults are saying less. Now let us go deeper into the legal mechanism, because Section 301 is the variable that can turn a venue squeeze into something far more severe, and almost nobody in the silver conversation is talking about it. Section 301 of the Trade Act of 1974 gives the United States government the authority to impose trade restrictions on any country it determines is engaging in unfair trade practices. When those restrictions are applied to a specific country, and when that country is also the origin point of metals sitting in American vaults, the legal situation becomes complicated very quickly. The relevant question is not whether the silver exists, it is whether the silver's country of origin disqualifies it from being used. In certain deliveries, exports, or settlement contracts, this is not hypothetical, it has happened before. When the United States imposed sanctions on Russia, Russian origin metals sitting in Western vaults became legally stranded overnight. Not destroyed, not stolen, just unusable for the purposes that the holders needed them for. The market had to rapidly source non-Russian supply. The price moved to reflect the scramble. If Section 301 is applied aggressively to China and the trade war has been escalating, not resolving, then Chinese origin silver sitting in COMEX vaults faces the same fate, and the complicating factor is that nobody knows exactly what percentage of the remaining registered inventory is Chinese origin. That uncertainty alone creates a risk premium. Market participants who cannot verify the origin of the metal they are counting on for delivery will pay more for metal whose origin is not in question. The Trump-Xi meeting, scheduled for May 15th, 2 days from today, is the immediate signpost. A genuine diplomatic resolution could relieve this pressure quickly. But Lanciani was pointed on this. He said that given this administration's tendency to generate open-ended outcomes rather than clean resolutions, the relief may not come as fast as the market hopes. His range for how long this persists: 20 days on the short end, 6 months if the geopolitics do not cooperate. 6 months of a venue squeeze on COMEX silver while China continues to pull 500 plus tons per month while domestic inventory continues to fall. That is not a quiet background condition, that is a pressure cooker. Let us look at the chart, because what the technicals are showing is where this fundamental pressure is being directed and what happens when it finally breaks through. The critical resistance level is $95 per ounce. Not 88, not 93. Those are important levels, but they are steps on a staircase. 95 is the ceiling, and what makes 95 exceptional is not that it appears on any single time frame. It appears on all three. It is confirmed on the daily chart. It is confirmed on the weekly chart. It is confirmed on the monthly chart. When a resistance level aligns across daily, weekly, and monthly charts simultaneously, the market is telling you something unambiguous. This is where the real decision lives. Silver right now is trading at $87.13. The first door between here and 95 is at $88. That is near-term resistance on the daily chart, and the first level that if silver closes convincingly above it signals the next phase of the move. Beyond 88, the next level is $93. Above 93, the final approach to 95 begins. On the downside, the structure is equally clear. The $81 level was broken to the upside recently, a decisive move that flipped a prior resistance point into current support. Below 81, 78, below that 75, and at the foundation around $72 per ounce, the chart shows a base built on multiple confirmed bounces. Bullish hammers, strong candles following each retest. That is not weak support, that is a foundation. Now look at what the chart is actually building. In early March, silver broke down from $95. That breakdown was steep, it was disorderly, it happened fast. From 95, the market fell aggressively and found its floor. Then the recovery began, and crucially, the recovery has been orderly. Systematic, methodical. Not a V-shaped panic reversal. A structured step-by-step recapture of levels. That contrast disorderly decline followed by orderly advance has a specific technical implication. The technicians who study these patterns note that when a market breaks down in a disorderly fashion and recovers in an orderly one, the breakout above the prior resistance tends to be disorderly on the upside. Steep, fast, difficult to position into if you are not already there. The formation being built is a cup. The left wall is the March breakdown. The right wall is the current orderly recovery. When silver returns to 95 and breaks through, the measured move principle applies. The depth of the cup, approximately $30 from the high to the low, becomes the upside target measured from the breakout point, 95 plus $30, $125 per ounce. If the market then consolidates below 95 for weeks or months before breaking through forming a handle on the cup, the pattern becomes a cup and handle, and the cup and handle measured move extends the target further toward approximately $180 per ounce. That is not a moonshot number conjured from thin air. That is the arithmetic of the technical pattern that this market has been constructing since March. The chart is not promising you a date, the chart is showing you a destination. Let us talk about what breaks this setup. Because this channel does not pretend risks do not exist. The Trump-Xi meeting on May 15th is the immediate variable. If that meeting produces genuine de-escalation, if tariffs are dialed back, if the Section 301 tension is relieved diplomatically, if Chinese silver begins flowing back into global markets, the venue squeeze reverses. The pressure that has been building releases. Silver does not collapse, but it consolidates, likely between $85 and $90. The cup continues to form, but at a slower pace. The 95 breakout gets pushed back on the calendar. Lanciani was direct about this. He said the meeting outcome could be very bearish for silver in the short term. Not catastrophically bearish, consolidation bearish. The kind of bearish that frustrates impatient participants but does not damage the underlying structure. The second risk is institutional framing. UBS says this is transitory. If UBS is right, if this is a brief inventory adjustment and not a structural shift, then the fundamental pressure resolves before it can force a technical breakout. Silver trades sideways. The cup forms slowly. The patience requirement extends. That is not a loss, but it is a waiting game. The third risk is market positioning. If enough participants have already bought silver anticipating a squeeze, the event itself could be a sell the news reaction. Price runs on the expectation. When the expectation is confirmed, weak hands exit. The price retreats from 88 or 90 without ever testing 93. This is how event-driven silver moves have historically resolved, not with a collapse, but with a deflation of urgency. Here is the reason none of these risks invalidate the setup. The cup formation is not a news event. It is a structural pattern built over months. If the China venue squeeze resolves next week, the chart does not care. The pattern is still there. The next catalyst, whatever it is, whenever it arrives, finds the same cup waiting, the same 95 resistance, the same measured move on the other side. The downside is bounded, the support at 81 and 78 is real, and the upside when the break happens is $30 to the measured move target, regardless of what triggered it. Postponement is not the same as failure. The structure holds. Now we need to overlay what is happening in the broader economy, because the macro environment is not neutral here. It is actively reinforcing the silver setup in ways that make the fundamental backdrop for this metal more compelling with each passing month. Core inflation. Printed at 3.8%. That is not a one-category anomaly. This is inflation that has spread across the economic structure. Auto insurance is rising again. Health insurance costs are climbing again. Owner's equivalent rent, the component that tracks housing in the CPI, is moving higher. Travel costs are rising because jet fuel costs are rising. This is no longer a spike in one sector. This is a broad-based embedded inflation that is becoming normalized. Lanciani's forecast is that inflation could reach 5% over the next 12 months, and the reasoning is specific. Two large, scheduled events are approaching. The FIFA World Cup is coming to the United States. The economic impact of hosting the World Cup, hospitality, construction, travel, food, security, broadcasting is enormous. It is an inflationary event at national scale, and then there is the United States semi-quincentennial, the 250th anniversary of the country's founding. Lanciani pointed to the bicentennial in 1976 as a historical parallel. That celebration was associated with a second inflationary wave that began in 1977 and ran for years, two large scheduled inflationary events, arriving on top of already elevated core inflation into an economy where the Fed cannot respond effectively. That is the Federal Reserve's trap. If the Fed hikes rates to fight inflation, it risks cracking the credit market. The credit market is vulnerable right now. A significant rate hike does not just slow inflation, it slows lending, tightens financial conditions, and if the shock is large enough, it triggers a credit freeze that cascades into employment and consumption. The cure becomes the crisis. If the Fed cuts rates or holds, inflation runs. The dollar's purchasing power erodes, and the assets that protect against currency debasement, silver, gold, copper, commodities, become the rational allocation by default. Given that choice, the Fed, historically and structurally, chooses inflation over recession. It always has. That means the inflationary environment is not a quarterly event. It is the operating condition for the foreseeable future. And in that environment, the silver thesis is not just about China and COMEX vaults. It is about every dollar-denominated asset holder eventually recognizing that something tangible needs to anchor their portfolio. When that recognition spreads, the capital flows into silver are not a squeeze. They are a structural reallocation, and structural reallocations do not end at 88 or 93. They run until the ratio of buyers to available supply reaches equilibrium. That equilibrium right now is not $95 per ounce. Before we talk about what to do, let us look at the other instruments in the metals complex. Because they are all speaking the same language right now, and together they form a coordinated signal that is very difficult to dismiss. Start with copper. Copper is the industrial metal that most directly reflects real economic demand. In December or January, copper broke out from a multi-year consolidation base on the monthly chart. First signal. Then the market pulled back and retested that breakout level. The retest held. Then copper made a new high. Breakout, retest, new high. That sequence is the most reliable bullish confirmation in technical analysis. It is not a spike that fades. It is a base that confirmed, consolidated, and extended. Copper is not suggesting that industrial demand is strengthening. Copper is confirming it. That matters for silver because the same industrial demand forces that are driving copper are driving silver, solar, electric vehicles, advanced manufacturing. Electrification infrastructure. If copper has broken out structurally, silver's industrial bid is not a temporary tailwind. It is the new baseline. Now look at the gold miners. The GDX, the large gold miners fund, is outperforming gold right now. Clearly, this is important because miners are a leveraged play on the gold price. When miners outperform gold, the market is front-running a move in gold that it believes is coming, and when silver outperforms gold at the same time that miners outperform gold, those two signals in combination are historically a precursor to accelerating momentum across the entire precious metals complex. Gold itself is the current laggard. At $4,688.30, gold is consolidating. It is following a pattern that played out into prior major breakout cycles 1973 and 2006. Each of those cycles featured a steep correction after the initial breakout, lasting approximately 5 months before the next major leg higher began. Based on that historical template, gold may be approximately 5 to 6 weeks from forming a meaningful bottom. Key resistance on the way up sits between $4,830 and $5,000 per ounce. A weekly close above $4,900 would be the clean signal that gold's next phase has started. But here is the strategic insight that cuts through all of these individual instruments. If you are bullish on gold, the higher leverage expression of that view is silver. Silver is gold's high beta counterpart. It moves more in both directions with greater amplitude. And when miners and silver are both outperforming gold simultaneously, the implication is not that gold is broken, it is that the market is positioning for gold's next move by rotating into the instruments that will benefit most when gold moves. Silver is one of them. The entire metals complex, copper at new highs, miners outperforming, silver recovering strongly, gold consolidating before its next leg is reading from the same script. The question is not whether the move is coming. The question is whether you understand the structure well enough to stay positioned through the noise between here and the breakout. So what is the actual framework for navigating this? The first thing you need to know is where the line in the sand is on the downside. There is a technical level tied to the daily Bollinger Band structure that currently sits around $82.10. If silver were to trade and settle below that level, the short-term upward momentum would be technically negated. That number is not static. It rises approximately 75 cents per day as the market progresses. Think of it as a rising floor. As long as silver is trading above that floor, the short-term momentum is structurally intact. The second thing you need to know is the sequence of confirmation levels on the upside. $88 is the first. That is the near-term resistance on the daily chart, a convincing close above 88. Not a spike and retreat, but a settlement signals that the next level is in play. 93 is the next meaningful resistance. Above 93, the market enters the approach zone for 95, and 95, confirmed as resistance on daily, weekly, and monthly timeframes, is the decision point that changes everything about the technical structure. The third thing is the May 15th calendar event. That is the Trump-Xi meeting. It is the immediate fundamental variable. Watch for the outcome. A de-escalation scenario means the China venue pressure releases in the short term. Silver likely consolidates between 85 and 90. The cup continues forming. The 95 breakout is postponed but not cancelled. An unresolved or escalatory outcome means the venue squeeze persists, the existing fundamental pressure continues to push upward against the technical resistance. The path to 88 accelerates. The timeline to 93 compresses. The fourth thing, and this is the one that separates participants who capitalize on this move from those who watch it happen without them, is understanding what 95 breaking actually means in real time when silver closes above 95 on a weekly basis. It has cleared confirmed resistance on all 3 major timeframes simultaneously. That is not a technical signal you can afford to wait to react to. The measured move target from that breakout is $125. Based on how this market has moved in both directions over the last 6 months, the thrust from 95 to the measured move target will not be slow, it will not be orderly, it will be steep, fast, and disorderly, the mirror image of the March breakdown. If you are not positioned before that break, you will be chasing. The fifth thing is the longer horizon. If silver reaches 125 and then consolidates, if the market builds a handle below that prior resistance, turn support, the full cup and handle pattern targets approximately $180. Lanciani said this could take 18 months to 2 years to fully develop. That is not a problem. That is a runway. The participants who understand the structure do not need it to happen by next month. They need to know where they stand relative to the pattern, and the pattern is in the right side formation of a cup right now, somewhere between 81 and 95, building toward the breakout that triggers the first measured move. Let us bring it back to today, Wednesday, the 13th of May, 2026. Silver at $87.13, gold at $4,688.30, copper at new highs, miners outperforming, inflation broadening, the Federal Reserve unable to hike without crashing credit, the FIFA World Cup and the semi-quincentennial loading additional inflationary demand into a system that is already running hot and beneath all of it. In the vaults of New York and the shipping containers of Shanghai, a venue squeeze that UBS documented, Lanciani confirmed, and the mainstream has not yet fully priced. The chart has one number for all of this: 95. It is the resistance, it is the ceiling, and it is the door, when silver walks through that door when it closes. Above 95 on a daily, weekly and monthly basis, the structure releases a measured move to 125. If the handle forms and breaks, the pattern extends toward 180. These are not predictions. These are the arithmetic of the technical pattern that has been forming since March. The support is defined, the resistance is defined, the macro is aligned, the industrials are aligned, the technicals are aligned, and the supply constraint is tightening by the week. May 15th will tell us something, the chart will tell us more, and if this video helped you see the structure more clearly, the levels, the pattern, the pressure that is building, hit that subscribe button and drop a comment below telling me which level you are watching most closely, 88.93 or the breakout at 95. This is the Asian guy. Stay patient, stay positioned. The structure does not lie.